The most dangerous financial collapses in history never announced themselves loudly. They didn't arrive with sirens or countdowns. They arrived quietly, wrapped in optimism, hidden behind strong markets and confident forecasts. And that is exactly why 2026 matters. Not because something suddenly breaks that year, but because by then, the decisions that determine the outcome will already be irreversible. Right now, most people believe risk is behind us, that the worst is past, that markets have adapted, central banks are in control, and the system has proven its resilience. But history shows this exact moment, when confidence returns too early, is when the foundation is most fragile. The warning signs are not emotional, they are mathematical. Global debt has expanded far faster than global productivity. Governments, corporations, and households are all leaning on leverage created during an era of cheap money and abundant energy. That era is over, but the obligations remain. Debt does not disappear when conditions change. It becomes heavier. Interest rates don't need to rise dramatically to cause damage. They only need to stay elevated longer than expected. Time is the real weapon. Every year of higher rates tightens cash flow, weakens balance sheets, and exposes weak structures that were never meant to survive under pressure. This is why 2026 is critical. By then, refinancing cycles collide. Governments roll massive debt. Corporations face maturity walls. Consumers feel cumulative pressure, not a single shock. Stress that was once manageable becomes systemic, and systems don't fail evenly. The first stage is denial. Markets continue climbing because liquidity still exists. Headlines celebrate resilience. Analysts explain away risk using new narratives. This creates false confidence. The second stage is divergence. Some sectors thrive, while others quietly break. Defaults rise in pockets. Volatility increases, but it's dismissed as temporary. This is where most people stop paying attention. The third stage is realization. Credit tightens suddenly. Risk premiums reprice. What was once safe becomes questionable. Liquidity disappears exactly when it's needed most. And the final stage is reaction. Policy intervention, emergency measures, narrative shifts. By then, outcomes are no longer preventable. Only damage can be managed. Uneven outcomes. Sharp winners, brutal losers, rapid narrative shifts, confidence breaking faster than it was built. This is why the smartest move right now is not prediction, it's preparation. Understanding that volatility is not temporary, that easy money is not returning quickly, that stability will be conditional, not guaranteed. Those who assume normal will return are the most exposed. Those who accept that the system is changing can adapt their expectations, strategies, and risk. History does not reward certainty, it rewards flexibility. The warning of 2026 is simple. Don't wait for headlines to tell you what already happened. Don't confuse short-term calm with long-term safety. And don't assume the future will look like the recent past. Because financial systems don't break when everyone is scared. They break when everyone feels safe. If part one was the warning, this is the anatomy of impact. Because once pressure reaches a critical point, the question is no longer if something breaks, it's what breaks first. History is very clear on this. Financial systems do not collapse from the center outward. They fracture at the edges, at the weakest links, at the places nobody is watching because attention is fixed on headline markets and index numbers. The first cracks never appear in stocks. They appear in credit. Credit is the silent foundation of the modern economy. When confidence exists, credit flows freely and invisibly. When confidence weakens, credit tightens suddenly, and everything built on it begins to strain. By 2026, the credit environment becomes the most dangerous part of the system. Corporate debt that looked manageable during low rates becomes fragile under prolonged pressure. Companies that survive by refinancing find doors closing. Lending standards tighten, margins shrink. Layoffs begin quietly, framed as efficiency rather than distress. This is the phase where denial is strongest. Markets may still look stable. Indexes may even rise, but underneath, the internal plumbing is deteriorating. Default rates tick up, not dramatically, just enough to be dismissed. That dismissal is critical because it delays response. The next fault line appears in real assets, especially commercial real estate. Office spaces remain underutilized. Valuations rely on assumptions that no longer hold. Refinancing becomes difficult. Regional banks feel pressure, not all at once, one by one. This creates localized stress that doesn't trigger immediate panic, but it drains confidence quietly. And confidence is everything. When lenders pull back, liquidity vanishes first, where leverage is highest and demand is weakest. Small institutions feel it before large ones. Local economies feel it before national headlines reflect it. This is how systemic risk hides in plain sight. Then comes the consumer layer, not through sudden collapse, but through exhaustion. Higher costs, slower wage growth, reduced discretionary spending, credit card balances stretch, delinquencies rise slowly, then faster. By the time it's noticed, behavior has already shifted. This shift matters because consumption drives growth. When consumption slows, earnings projections break. When projections break, valuations reprice. When valuations reprice, sentiment flips, and sentiment flips faster than fundamentals. This is where volatility becomes violent. Algorithmic trading amplifies movement, passive flows reverse, liquidity disappears at the exact moment fear spikes. Markets gap, not slide. People who thought they had time realize they don't. But the most dangerous break doesn't happen in public markets. It happens in trust. Trust between banks, trust between governments, trust between institutions and populations. Once trust erodes, coordination fails. Policies become reactive. Communication becomes defensive. Signals conflict. This is when instability accelerates. Governments face impossible choices: support markets or fight inflation, protect currencies or protect growth, stabilize banks or preserve credibility. Every action creates a new vulnerability. By 2026, there's no clean solution, only trade-offs. And trade-offs create winners and losers. Capital flows toward perceived safety, not necessarily what is safest, but what feels safest. This can distort markets further. Bubbles form even during stress. Safe havens overcrowd. Risk misprices again. This is how instability sustains itself. Meanwhile, geopolitical tension acts as an accelerant. Energy constraints, trade disputes, regional conflicts. They don't cause the financial break, but they magnify it. They reduce margin for error. They shorten reaction time. Every external shock lands harder in a system already under strain. The most misunderstood part of this phase is timing. People expect a single event, a crash, a headline. But what actually unfolds is a sequence. Each stage reinforces the next. Each delay increases severity. By the time fear becomes mainstream, positioning is already locked in. This is why Part 2 matters more than Part 1, because warnings without understanding of impact create anxiety. Understanding impact creates preparedness. Preparedness doesn't mean predicting exact dates or assets. It means understanding fragility, recognizing where leverage is highest, where assumptions are weakest, where confidence is performative rather than real. It means watching credit spreads instead of hype, balance sheets instead of narratives, incentives instead of promises. It means accepting that the next crisis will not look like the last one, but it will feel familiar in retrospect. Every generation believes it's smarter than history. Every system believes it's more advanced, and every collapse proves structure matters more than belief. The people who navigate this phase successfully are not the most aggressive or the most optimistic. They are the most adaptable. They move early. They reduce exposure before panic. They don't chase certainty. They manage risk. Because when systems fracture, speed matters less than position. By the time the majority reacts, options narrow. This is not a call to fear, it is a call to clarity. The 2026 warning is not about predicting doom. It's about recognizing that stability is no longer the default. It must be earned, defended, and understood. And in the next part, we go even deeper into who benefits from this transition, where power relocates, and how systems reset after pressure breaks them. Because after every fracture, a new order emerges. The only question is who understands it early, and who is forced to accept it late. If Part 2 exposed the fractures, Part 3 explains the winners, the losers, and the invisible forces already reshaping the financial landscape. Because every systemic crisis is not just destruction, it is redistribution. Power, capital, and influence move quietly before headlines ever report a problem. The first principle is simple: liquidity is king. In normal times, capital flows freely, but when the system tightens, the value of liquidity surpasses almost every other metric. Cash, reserves, and assets that can be converted instantly become the most valuable commodities. Paper wealth, high valuations, and speculative positions become liabilities overnight. Those who understood this shift in advance are quietly fortifying positions. Those who didn't will realize too late that perception of wealth is nothing without access. The second principle: diversification is necessary but insufficient. Geographic diversification no longer guarantees safety. Political risk, trade barriers, energy constraints, and currency volatility are synchronized across regions. The traditional playbook of spreading risk across borders only works when systems operate independently. 2026 proves they do not. Interconnected fragility ensures that shocks in one region ripple globally in days, not years. Third, energy continues to be the hidden multiplier. Financial stress is amplified where energy scarcity intersects with leverage. Nations dependent on imports feel strain first. Regions overextended in manufacturing or infrastructure investments tied to unstable energy sources face cascading defaults. Markets may ignore this at first, but the pressure accumulates silently, preparing the conditions for sudden repricing. Energy is not just a commodity, it is leverage embedded in every transaction, every balance sheet, every contract. The redistribution pattern is predictable. The first movers are financial institutions with foresight, the ones that understand leverage, liquidity, and systemic pressure. They tighten exposure, prioritize solvency, and exploit mispricing. Their gains do not come from speculation alone, but from understanding the mechanics of fragility. Next come governments and sovereign funds. Those with energy independence, strong reserves, and control over strategic assets can maneuver decisively. They stabilize domestic markets internally while acquiring distressed assets externally. This is where policy and opportunity align. By the time international observers notice, power has shifted. The public often sees only the consequences: market volatility, rising prices, and institutional bailouts. Few understand the silent calculus behind each decision. Every delayed intervention, every tightened regulation, every strategic acquisition is a move in a game that most participants don't even know exists. Meanwhile, systemic inertia punishes the latecomers. Banks, corporations, and individuals caught with over-leveraged positions face rapid erosion of capital. Margins that seemed robust shrink under stress. Credit lines vanish, opportunities close. Panic begins to manifest publicly, but the critical losses have already been absorbed by those positioned correctly. Timing, as always, is the decisive factor. Not speed, not emotion. Positioning. Those who act early, quietly, and methodically survive and sometimes thrive. Those who wait for confirmation are forced to respond to events, not influence them. And the most dangerous mistake is underestimating duration. Recovery, stabilization, or resolution does not happen in weeks or months. Structural adjustments take years. Policies that appear effective in the short term often fail to resolve underlying fragility. Markets may bounce temporarily, creating illusions of security, but deeper vulnerabilities remain, silently accumulating toward the next stress point. This is why understanding systemic mechanics matters more than daily market news. Headlines reflect reactions, not causes. Price spikes, rate hikes, and defaults are symptoms. The underlying drivers are structural: debt cycles, energy constraints, geopolitical alignment, and leverage distribution. In Part 3, the focus shifts to preparation, not speculation, not panic. Understanding how resources, influence, and capital flow under stress allows for deliberate, calm, and strategic positioning. Preparation begins with clarity about systemic dependencies: which assets are sensitive, which institutions are fragile, which regions are vulnerable. Next comes redundancy. Simple, but often ignored. Having alternatives to critical dependencies, liquidity, supply chains, energy access, drastically reduces exposure during systemic stress. Redundancy is not inefficiency, it is survival. Finally, adaptation is continuous. No strategy is fixed. Policies, markets, and global dynamics evolve under pressure. The ability to pivot based on observable systemic stress is more valuable than any single prediction or forecast. The 2026 financial warning is not about fear for its own sake. It is about understanding invisible forces, observing patterns ignored by the masses, and positioning before systemic shifts become obvious. Awareness, foresight, and methodical action define who survives and who does not. If this resonates, it is time to internalize the rules quietly. Observe leverage, monitor energy dependencies, watch liquidity, and understand systemic fragility, because those who comprehend the mechanics can navigate volatility without panic, while the unprepared are swept along by forces they never recognized. In the next part, we go further, into practical positioning strategies, the sectors most at risk, and where opportunity quietly moves in the shadows of collapse. Because in every financial cycle, power is never destroyed. It is merely relocated quietly, methodically, and decisively. Stay alert, stay informed, because the system is already moving, and 2026 will reveal the consequences of decades-long decisions in real time. If Part 3 revealed who benefits, Part 4 exposes how to position before the system locks. Because knowledge without action is wasted, and understanding systemic fragility without response guarantees exposure. The first principle of positioning is clarity, not the clarity of opinion or hope, but the clarity of structure. Debt, leverage, liquidity, energy, and geopolitical alignment are not abstract concepts. They are variables you can observe, track, and analyze. Each interacts with the others. Each determines vulnerability. Those who map these variables understand which positions are exposed and which can withstand systemic pressure. Start with leverage. Corporate, sovereign, and personal debt are the first to transmit stress. Low-interest environments created hidden obligations, often ignored or underestimated. By 2026, refinancing walls collide. Anyone relying on borrowed liquidity to sustain operations is at risk. Positioning begins by identifying exposure, debts that are adjustable, assets that are liquid, and obligations that can be deferred. Check. Next, energy dependency. Financial fragility is inseparable from energy scarcity. Regions, sectors, and companies reliant on imports, unstable infrastructure, or politically sensitive supply chains will face cascading stress. Energy constraints amplify debt vulnerability, magnifying defaults, bankruptcies, and market repricing. Verified. Liquidity is the ultimate survival asset. In times of systemic stress, cash is not passive, it is power. Access to liquid reserves allows opportunity capture when others are forced to sell. It also provides flexibility to respond to unexpected shocks. Undeniable. Diversification matters, but the type of diversification matters more. Geographic, asset, and sector diversification can fail when correlation rises during crises. In 2026, global interconnectivity ensures shocks propagate rapidly. Real diversification requires analyzing dependencies, systemic linkages, and potential bottlenecks, not just spreading positions blindly. Then comes timing. Positioning too early creates opportunity cost. Positioning too late exposes you to losses. The correct approach is continuous observation, monitoring leverage cycles, liquidity conditions, energy constraints, and policy decisions. Adaptability is more valuable than fixed certainty. Institutional behavior provides insight. The largest, most informed entities do not panic. They move quietly shifting assets, adjusting exposure, and securing critical positions. Observing their actions, bond purchases, reserve adjustments, strategic acquisitions, can signal systemic stress before public awareness. Behavioral psychology plays a critical role. Public perception lags reality. Masses react to headline shocks, while structural shifts occur silently. The period between structural change and visible panic is the opportunity window. Recognize it. Exploit it responsibly. Geopolitical shifts are inseparable from financial shifts. Energy constraints, trade restrictions, and sanctions accelerate systemic stress. Nations with strategic reserves and controlled energy supply can maneuver decisively. Those dependent on imports are forced to react. Understanding which regions and sectors are leverage points allows anticipation of where stress will materialize first. Policy intervention must be understood as limited, not absolute. Central banks, governments, and international institutions act under constraints. Tools like interest rate adjustments, liquidity injections, and market support have diminishing returns when structural debt and energy imbalances dominate. Don't assume policy will create stability. Assume it will slow reaction, not prevent consequence. Psychological preparation is equally critical. Panic spreads faster than information. Understanding that volatility is structural reduces reactionary behavior. Calm, methodical observation, and calculated positioning outperforms emotional reaction every time. Next, recognize the invisible movers of wealth. Large institutions, sovereign funds, and strategic investors have access to data and systemic insight not available publicly. Their movements indicate where liquidity is concentrated, where exposure is being reduced, and where opportunity is quietly emerging. Following signals without copying blindly allows strategic alignment with systemic currents. Scenario planning is indispensable. Systems do not behave linearly. Stress may appear in one sector first, propagate through another, and materialize visibly elsewhere. Running mental models, debt shocks, energy disruptions, liquidity crunches allows anticipation rather than reaction. Predicting exact timing is impossible. Predicting sequences is not. Finally, adapt continuously. The 2026 system is dynamic. Policy, markets, energy flows, and geopolitical tensions shift in response to each other. Static strategies fail. Flexibility, monitoring, and decisive adjustment are the keys to survival and strategic advantage. Understanding the rules creates perspective. The crisis is not random. It is the natural outcome of accumulated debt, leveraged positions, constrained energy, and interconnected markets. Treating events as isolated errors or temporary disruptions ensures exposure. Treating them as parts of a systemic pattern allows positioning, preparation, and opportunity. For those who observe closely, the opportunities in 2026 are significant. Not in speculation alone, but in anticipation. Not in luck, but in clarity. Not in panic, but in preparation. Strategic allocation, liquidity management, energy understanding, and systemic observation define survival, resilience, and even advantage. The lesson is simple. Do not wait for headlines. Do not assume intervention guarantees safety. do not expect the system to behave according to recent patterns. Instead, study the structure, watch the signals, manage exposure, and prepare to adapt. Because in 2026, the world will not reward hope. It will reward awareness, foresight, and methodical action. And as always, history proves it. Systems that understand structure survive. Those that ignore it are swept along, forced to respond, and often crushed. The choice is yours: awareness and preparation, or reaction and regret. If Part 4 showed how to position, Part 5 reveals the aftermath. The new rules of engagement, the structural consequences, and the irreversible shifts that follow systemic stress. Because no crisis exists in isolation. Every shock redistributes not only capital, but power, influence, and opportunity. And the 2026 financial warning is no exception. The first reality to understand is that recovery is not uniform. Systems do not return to previous equilibria. Structural damage, debt overhang, energy constraints, and geopolitical stress leave permanent footprints. Markets may bounce, indexes may recover temporarily, but the underlying fragility remains. What was once a temporary disruption becomes a long-term redefinition of risk and value. Second, the redistribution of power is inevitable. Those positioned with liquidity, low leverage, strategic reserves, and access to information consolidate influence. Sovereign funds, energy-independent nations, and large institutions capable of navigating complexity emerge stronger. Those overexposed, dependent, or misinformed lose not just wealth, but strategic positioning. Check. Third, policy and intervention no longer define outcomes, they delay them. Governments can stabilize short-term markets, inject liquidity, or adjust interest rates, but structural imbalances continue to pressure systems. Delay increases final severity, not safety. History proves that every postponed reckoning compounds consequences. Verified. The fourth consequence is behavioral and societal. Populations exposed to stress adjust expectations. Consumption patterns change. Risk tolerance shrinks. Political polarization rises. Confidence in institutions erodes. These changes do not reverse quickly. They shape economic, political, and social dynamics for decades. Energy continues to act as the multiplier. Scarcity, volatility, and geopolitical leverage determine not only market outcomes, but the ability of nations to respond effectively. Energy independence, strategic reserves, and access to supply chains become defining factors in survival and influence. Undeniable. Credit markets evolve differently post-crisis. Risk premiums remain elevated longer than anticipated. Lenders demand collateral and security. Volatility becomes structural rather than episodic. Traditional assumptions about liquidity, leverage, and correlation no longer hold. Those who internalize these new rules gain significant strategic advantage. Sectors previously considered safe may no longer be resilient. Real estate, highly leveraged corporations, energy import-dependent regions, and heavily indebted governments face long-term constraints. Opportunity shifts to areas aligned with structural stability, energy-efficient infrastructure, liquidity-rich institutions, resource-independent regions, and entities capable of rapid adaptation. Technology amplifies both risk and opportunity. Digitization, automation, and reliance on complex networks create concentrated vulnerability. Simultaneously, technology allows those who understand systemic stress to monitor, predict, and respond faster than historical participants could. Adaptation is rewarded more than speculation. Global interconnectivity ensures that shocks are not isolated. A default in one region cascades across borders. Trade, currency, and investment flows amplify vulnerability. Those who understand systemic pathways can anticipate impact zones, mitigate exposure, and position for advantage. Those who focus only on local or short-term signals are caught off guard. Psychology and perception are decisive. Markets recover partially because human behavior often lags underlying reality. False confidence allows some to re-enter markets prematurely, while structural fragility remains. Patience, observation, and discipline become the most valuable assets. Acting too early or too late carries high risk. By 2026, it will become obvious to most only in hindsight that patterns were predictable. Defaults, volatility, and stress do not appear randomly. They are the cumulative result of decades of debt accumulation, energy dependency, and interconnectivity. Recognizing these patterns in advance provides strategic advantage. The most important principle is adaptability. Fixed strategies fail. Static assumptions collapse under evolving conditions. Flexibility, continuous observation, and readiness to act define survival and prosperity. Positioning is not a one-time decision. It is a dynamic process. For individuals and institutions, the practical takeaway is clear. Monitor leverage cycles, prioritize liquidity, understand energy dependencies, analyze systemic interconnections, and maintain operational flexibility. Recognize that markets and governments act under constraints, not omnipotence. This mindset transforms uncertainty from a threat into an actionable framework. History repeats, not in exact details, but in systemic patterns. Observing these patterns allows anticipation. Ignoring them ensures reaction. And reaction, especially in complex interconnected systems, is always slower and more costly than proactive positioning. The final truth is unavoidable. 2026 is not a prediction. It is the convergence point of long-term structural trends. Financial overextension, energy constraints, geopolitical tension, and interconnected fragility are already in motion. The world is shifting, whether widely acknowledged or not. This channel exists to provide clarity in that chaos, to reveal the hidden forces shaping markets, nations, and institutions, to expose patterns before panic spreads. Knowledge without action is wasted. Observation without implementation guarantees exposure. If this series changed the way you view the financial system, take one deliberate step now, like this video. It helps others access the same awareness, the same perspective, the same strategic clarity. Then, subscribe. Because the next series dives into how these structural shifts reshape industries, redefine national power, and create opportunity that only the observant can exploit. And finally, stay alert, monitor patterns, position strategically, adapt methodically. The 2026 warning is not about fear. It is about awareness, preparation, and understanding the system before the crowd reacts. Because in systemic shifts, knowledge is the most valuable currency, and timing is everything. The world is already moving. Will you move with it, or be swept along? And now the message is clear. 2026 will not arrive quietly for everyone. The financial, energy, and geopolitical forces shaping this era are already in motion. Systems will fracture, defaults will rise, and volatility will become the new normal. But the difference between those who survive and even thrive and those who suffer losses is awareness. Preparation is not about predicting exact events. It is about understanding patterns, recognizing fragility, and positioning strategically. Liquidity, energy independence, low leverage, and adaptability are the true advantages in this coming phase. Observe, analyze, and act deliberately, because reaction is always slower and costlier than foresight. If this series gave you insight into the hidden forces shaping the world, don't just watch and move on. Hit the like button. It helps this message reach others who need to see it. And subscribe now, because the next video will go deeper, uncovering the sectors, regions, and strategies that will define survival and opportunity in 2026 and beyond. The system is already moving. Knowledge is your tool. Clarity is your advantage. Position yourself before the shift becomes visible to everyone else. Stay informed, stay strategic, and I'll see you in the next breakdown.